It's indeed noteworthy that the range of demand estimates that exist at the moment for 2024 is unusually wide. You mentioned the two numbers that bookend the range of estimates. The IEA is by far the lowest in the market with a forecast of just about 1 million barrels a day of demand growth. At the far end of the spectrum is the OPEC Secretariat with 2.1 million barrels a day. That spread of a little more than 1 million barrels a day is wider than I remember it ever to have been. Most other people are, somewhere in the middle. I find both of these estimates a little unlikely, but the spread is very wide. Now, having said all of that, it is true that demand growth is decelerating. The couple of years that we had of strong post-COVID recovery, they are by and large done. And it's also the case that demand over the summer is not quite living up to the expectations we had a couple of months ago when we had data points that suggested that this could be really a very, very strong summer. That is also not quite happening. So I would suggest that arguably the IEA is probably more on the right track than OPEC, and numbers on the whole on demand estimates have been coming down.
There's a lot that divides the IEA and OPEC, but the one thing that unites them is the outlook on China, both citing concerns around the deteriorating economic outlook. Do you share those concerns, and what should we expect to see from the Chinese growth story in the next 6 to 12 months?
Yeah, when it comes to oil, there are quite a few things happening in China that have sort of all of a sudden come together that has created this quite sort of significant change in the trajectory for oil demand. First of all, there's the broad economic backdrop, which is for slower growth at the moment and probably in the future than we've seen in the past. But that is only one of several things. What we're also seeing is a significant uptake, of course, of electric vehicles, and that means that gasoline demand probably still has some growth left in it in the next year or two, but we are probably approaching the peak in Chinese gasoline demand with the electrification of cars. What then also plays a role is substituting diesel for trucking by natural gas. Given that LNG prices recently have been quite competitive, it's become more economic in China to buy LNG fueled trucks rather than diesel fueled trucks. So LNG is substituting for diesel, and that's a headwind of a sort of 150,000 barrels a day or so in this year's demand growth. And then China has seen several years of very strong expansion in its petrochemical industry. That consumes also significant amounts of oil, particularly the LPG and the ethane part of the barrel. But petrochemical margins are really very, very weak. So that expansion is slowing down quite significantly. When you add all of that up, the broad economic growth picture, of course, but electric vehicles, LNG into trucking, and then petrochemicals, you end up with this slowdown in oil demand that we are now seeing.
One thing we've also been unpacking with experts and analysts over the last couple of weeks is the geopolitical risk premium in this market. How do you see Middle East tensions impacting the oil price moving forward, and what is that geopolitical risk premium in your view?
Yeah, much smaller at the moment than it has been in the past. I think many of us who've been watching the oil market for a good while are perhaps a little surprised how little geopolitical risk has actually moved the price. But I would say there are two important reasons that explain the somewhat lackluster impact of geopolitical risk on oil prices at the moment. First of all, OPEC has quite significant amounts of spare capacity. Estimates vary a little bit, but by and large, Saudi Arabia, the Emirates, combined with smaller levels of spare capacity in other countries, OPEC has somewhere between 5 to 6 million barrels a day of spare capacity. Now, that doesn't mean that 5 to 6 million barrels a day is available tomorrow. When spare capacity goes to 2 million barrels a day or less, the oil market does get nervous, but it does mean that there are several millions of barrels a day of spare capacity on the sideline in case there is a disruption. The second thing that also plays a role is that these days we have radical transparency in the oil market. We can see the flow of oil all day, every day through satellite observations of tankers, of storage depots, and we can see that there is no disruption to the flow of oil as of yet. And so this is very different from in the past. If you roll the clock back sort of 10, 15, 20 years ago, often we were a bit in the dark on what these political events actually meant for the flow of oil. But these days, we can see that there is no disruption. So if there's no disruption so far and there's significant spare capacity on the sidelines, then geopolitical risk can impact the price of oil only by so much. So there's probably a few dollars in the price for heightened risk. But at the moment, it's probably not much more than that for these reasons.
And just very quickly, your update on what this all means for prices. I see your latest price call, the forecast here, 80 USD in 2024, 75 in 2025. Why? That's basically where we're at.
Yeah. Look, the market for crude oil is tight at the moment. We can see that in many different indicators, primarily inventories. Crude oil inventories are drawing, and that supports prices in the in the 80s, mid 80s type level. Hence the forecast for the third quarter at sort of $85 a barrel as we have it. However, this depends on a set of factors that are likely somewhat transitory. We're benefiting from peak demand at the moment, so refineries are running hard. And also the OPEC deal is still in place, but from the fourth quarter onwards, OPEC has also indicated that it will add oil back to the market. As we roll the clock forward into 2025, we see OPEC growing supply, we see non-OPEC growing supply. Demand is also growing, but slower than in previous years. We suspect that next year oil inventories will build at a rate somewhere between 0.5 to 1 million barrels a day. The market will be in somewhat of a surplus next year. And with that, we see some moderation in the price of oil. Not much beyond sort of the mid-70s. We don't see prices lower than that, but a moderation from current levels nonetheless.